Let's just get right into it. The markets are falling. And let's be honest, our anxiety levels are probably rising. It's a feeling that pretty much every investor is wrestling with right now. So the big question is, what do you do? Well, today, we're going to try to cut through all that noise and find a calm, steady path forward.
Yeah, I bet this sounds familiar. If you've dared to look at your portfolio lately, this thought has definitely crossed your mind. And you know what? That feeling of worry is completely 100% natural. Nobody likes seeing red. But it's in these exact moments that having a bit of understanding and a lot of discipline really matters.
This is the big one, isn't it? The question that keeps you up at night. And if we're being totally honest, the answer is, yeah, they might. They could fall further, and that's something we just have to accept. But listen, accepting it doesn't mean we have to panic. It just means we need to get our mindset right for whatever comes next.
And this is where we need to zoom out a little bit. We need to shift our focus from the scary short-term to the long-term reality. Look, this is not the first time the markets have been spooked by uncertainty, and it for sure won't be the last. History gives us a pretty reliable roadmap if we're willing to look at it.
I mean, just think about it. We've lived through some major global shocks, right? The massive financial crisis, sudden interest rate hikes that shook everyone, a literal global pandemic. Every single one of them caused sharp, pretty painful downturns. And what happened every single time? The markets eventually recovered. This whole pattern of a dip followed by a recovery, that's not a bug. It's a feature of how markets work.
Now this right here is probably the most important thing to get your head around. The difference between a temporary decline and a permanent loss. Right now, that drop in your portfolio is just on paper. It's not real, yet. It only becomes a real, permanent loss if you do one thing: panic and sell. The key thing to remember is that you're in control. The loss isn't real until you make it real.
Okay, so this leads to the most common question I hear when things get rocky. It seems so logical, doesn't it? Things are going down, maybe I should just pause my investments until it's all over. But honestly, this is where so many people make a huge mistake.
And this analogy just nails it. Imagine your favorite brand, the one you love, announces a huge 50% off sale. What do? Do you say, nope, not shopping there until the prices go back up? Of course not. You'd see it as an amazing opportunity. Well, a falling market is basically a sale on your investments. Stopping your SIP now is like walking away from a massive discount. Let's quickly break down why this is so powerful. When you keep your SIP going, that same amount of money you always invest now buys you more units of your funds simply because the price is lower. This is called cost averaging, and it's basically the superpower of the SIP. It's literally designed to make the most of these ups and downs. So, what if you're not doing an SIP? What if you've got a lump sum of money you want to invest? Well, trying to perfectly time the market and invest at the absolute bottom, that's pretty much impossible. A much smarter way is to stagger it. You invest your money in smaller chunks over a period of time. This way, you reduce the risk of putting all your cash in right before another potential dip.
Okay, we need to talk about the app. You know the one, constantly refreshing it, watching the numbers go up and down. I get it, it's tempting, but it's a recipe for anxiety and bad decisions. Your goals, whether it's retirement or a down payment on a house, are years away. Your focus needs to be long-term, not minute to minute.
So, let's just boil this all down into a really simple, actionable game plan. 4 steps. First, and most importantly, don't panic. Just take a breath. Second, do not stop your SIP. This is when it's working hardest for you. Third, avoid any sudden, impulsive moves. And finally, number 4, stick to your goals. Because if your long-term goals haven't changed, then your investment plan shouldn't either.
Really, this is all about a mental shift. We need to reframe this whole situation. Stop seeing a market drop as just a threat. See it for what it actually is, a necessary reset. These are the moments that create incredible opportunities for investors who can stay disciplined and think long-term. And if you only remember one thing from our chat today, please let it be this. Market falls are temporary. The fear you might be feeling, that's temporary too. But your discipline, that can be permanent. And that is the single thing that will build real, lasting wealth over time. And of course, just a final important note. Everything we've talked about is for educational purposes. Mutual fund investments are subject to market risks, so you should always read the offer documents carefully. And it's always a good idea to chat with a qualified financial professional before making any investment decisions.